Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. We're going to do a quick recap, and quick, not just because we want to look at what's happened over the last week, but quick, guys, because while we're talking, prices are still moving today, having a pretty volatile day following on the heels of another FOMC release earlier. So let's take a look starting with gold. I did this about 20 minutes ago, so we're going to have to correct some of these as we go. Gold at around 23.10, so I think it was down about $5 for the week, but it's actually back up to 23.20 as we're talking, so therefore gold's actually up about $5 on the week. We did have a little break there below 2,300, but we are back up above 2,300, and it does seem to be climbing. Silver down at around 26.55. I think it's 26.75 as I'm talking. So we're down a little under 2% on the week. Platinum, 948 when I wrote it down. I think it's around 965, 970. So platinum's actually up over 5% since we recorded last Wednesday. And platinum, we'll look at the chart here in a minute, but it does look like it might be climbing. So climbing not just here this week, but over the last couple weeks in general. And palladium, platinum's sister metal, same story. I saw it at 949, down about 5%. That's a little bit higher as we talk, but the key here is platinum and palladium parity that we're going to go into here in a sec. And I want to finish off with the dollar and the equities. So taking a look at the dollar index, a little bit of a bump up from last week, about 0.25%, but it's actually down here today following the Fed announcement. And finally, the S&P down about 1% from last week, sitting at 5,018, but it's continuing that trend as we speak. So there's a lot of stuff happening as I speak on a Wednesday afternoon. And of course, we're going live with this show on YouTube tomorrow on Thursday when you in the listener world are hearing it. So we may have some changes since then as well. So volatile day, guys. Where are we starting today?
Yeah, we record this show on Wednesday afternoons because of the FOMC. So as the Federal Reserve comes out with their announcements somewhat consistently through the year, not every month, but we realized with the market reaction that you almost always see, it was important to have it kind of hot off the press. So record on a Wednesday after the chairman speaks and then release it on Thursday. And all that to be said, today is one of those days. And Chairman Powell came out and the markets got all excited because he said that he's kind of ruling out a hike, that it's unlikely that the Federal Reserve's next move is going to be a rate hike. He has no concerns about last week's CPI numbers coming in lower than expected and the PCE coming in higher, which is an indication of stagflation. And his quote was, "I don't see the stag or the flation." So he's downplaying the fact that there's a stagnant economy in the numbers or that there's inflation that's going against what they want to see. And he really did say, quote unquote, a lack of further progress, towards that 2% goal is what they're seeing. Well, yeah, it's not just a lack of further progress. That's a nice way of saying it's moving the wrong way,
Not holding nice. Yeah.
Yeah, holding nicely. A lack of forward progress is also the stag that he's not seeing.
And the inflation. It's the inflation.
Oh, my goodness.
Anyway, so we'll see. To me, I think the markets got more excited about the fact, one, suddenly we've gone from...
not going to have a rate hike.
Yeah.
But he also isn't putting the punch bowl back out on the table either. He's not talking about a rate cut.
That's right. And the markets rally on the fact that there's rate cut news, and then the markets rally on the fact there's not a rate hike. The markets just rally.
And then the market gave it all back when they realized, wait a minute, he didn't say anything about a rate cut.
Yeah.
And so suddenly they had that uh-oh moment thinking, okay, good, there's not going to be a rate hike. But wait a second. It's not what he said, it's what he didn't say. That's why you're seeing such a dramatic turnaround from the markets today.
Well, at one point, the Dow I saw rallied up almost 500 points, and now as we record, it's up just a little bit, 70 points or something like that. It's given almost all of it back. And gold did the same thing when they first came out. Gold popped from just under 2,300 an ounce to 2,325 in just a matter of minutes.
Yep.
And it's retraced a little bit there, so it's going to respond, and the dollar turning down. That makes all the sense. But to me, what the Fed said most significantly is that they want to be careful with the Fed balance sheet reduction. So as they go to reduce the Fed balance sheet, they need to find the sweet spot. So they want to slow it down. They were doing 60 billion at a whack, and they're going to slow that down to 25 billion. Well, that's stimulating. I don't care what anybody says. That's no different than starting to increase the balance sheet. The markets are going to react.
Right.
So again, we'll see. And it just makes me nervous because on top of that, we really do need sort of this hawkish activity from the Fed. It's the most responsible thing to do because the Treasury's out of control. I mean, Janet Yellen issued $7 trillion in new debt in the fourth quarter in 2023. It comes out, and that's up 60%. And it's up 600% since 2008. The current rate since the pandemic, even, it's up 60%. But those are huge, huge numbers. And the problem is that everything depends on the illusion that every penny of federal debt is going to be repaid in full with interest. And at some point, it's not possible. Like, everybody's going to realize it can't pay it back, much less pay it back with interest. So if the treasuries crash and they don't do something to rein in this game, that means the entire banking system and the pension system and hundreds of corporations go into default, and it would break the payment system. To me, that's what people just aren't paying enough attention to. So Miles, you said something in the opening about gold coming down to test. I think it's twice, right, that we've seen 2,290-ish roughly on those pullbacks. Has anything changed in terms of your support levels to the downside?
No, I mean, the support levels are going to be built back off some lows going back to February of this year before we had the big push up above the previous highs, that 2150, 2180. So no, support levels aren't going to change too much as far as potential retracements back down. I'm still looking at gold coming down. It's my argument is always the trend continues until proven otherwise. So I'm going to be looking at gold probably coming down somewhere to the 382 is not too far below where we're at now. You could even argue we possibly hit it depending on where you want to start your fib levels. I tend to err on the side of not using the bottom, but using where the breakout move took place, which would be around February 28th, March 1st, that couple day period in there. And that actually puts us right at the 382 today. So we could have, if not should have, seen a little bit of a bounce in the gold price today anyway, regardless of Fed announcement. I think what the Fed announcement does is it adds more credibility to the argument. What I do find interesting is the Fed continues to talk about not raising interest rates as a solution. It's a non-solution. Raising interest rates is doing something. Lowering interest rates is doing something. They're just talking about doing nothing. And apparently nothing has quite a bit of effect on the market as we're seeing today. So if nothing is having this volume of effect on the market, and this is how reactive people are, with the hope, well, what happens if it's not hope? What happens if it's a definitive decision? So I'm glad you brought up the central bank balance sheet that is continuing to decline. You would expect on an announcement like today, the dollar to go down. You'd expect most of your markets to kind of do what they did. But it is funny how the anticipation is leading into the result. We look at what the markets did, say, yesterday in anticipation of the Fed announcement today, and then what the response is. So, yeah, I think this is just a more volatile expression of what we expect to see happen anyway.
And silver, similarly on both of these pauses or pullbacks, silver came down below 27 and held kind of above that 26.20 mark. And I don't know if these are going to play out to be real strong support levels or they're just temporary on a bigger pullback or not, but it sure would be nice if this was the floor. I feel like we're always one news event away from just another pop, like today, the FOMC.
Well, and if you look at copper's been up this year and it's holding its gains in spite of all the volatility around it. So I think copper is signaling to the silver crowd, hey, silver is going to take off. Now we'll see, because we've been hearing that for years. But I still hold out hope for silver to have a run. Now, it looks like the spring season may be ending. We're going into the summer months. We may not see the big rally like I hoped we would until the fall. But like you said, Tori, we're only one event away from anything happening.
Yeah, and last week, I mean, we can't fail to mention the one event that happened in the banking sector. We've been talking for
Republic.
a year. Yeah. I mean, here you have your first one of 2024.
Yeah, and it's a big one.
Yep. And Republic First is an indication to me of a couple of things. One, it's the interest rate market environment. Two, it's commercial real estate exposure.
Yeah.
You know, as you dig in, that's really what it was. So there's a news event that they don't even want to discuss.
No, it was a brief flash and then, okay, nothing to see here, folks.
Yeah. It's ironic that it's Republic First. I wish they would actually put the Republic first and, you know, these sorts of things wouldn't be happening. But all that to be said, it's like, look, if this is an indication, you have to look deep. I mean, last year, the banks laid off 66,000 employees, the major banks, 66,000. In the first quarter of 2024, this year, we had 220 branches close. So even though there aren't bank closures from the standpoint of bank failures, they are closing branches left and right.
Yeah.
And so that's a scary thing. We talked about Bank of America shares sliding as charge-offs on non-performing loans exceeded estimates. Well, that's going to go across the board. But this Republic First Bank is like the sweet spot of exposure to me to the issue with commercial real estate exposure. And so the largest banks aren't the ones that are at great risk. It's the intermediate, yes. Yeah. It's not the tiniest or some, but the small banks, the ones that are less than 10 billion in assets, those are the ones that have like 38% of the commercial real estate exposure. And if you start getting 40 or 50 of those fail, now it's major news.
Yeah.
But unfortunately, they're the ones that have all the leverage and all the exposure to the commercial real estate market.
Well, and it's interesting the way you stated that too, Tori. You know, here's your first bank failure of 2024. Saying it that way makes an assumption, to be fair. You know, you're making an assumption there. But what's interesting is looking at the headlines. Fox is making that assumption. Wall Street Journal's making that assumption. Investopedia is making that assumption. Washington Examiner is making that assumption. BizNow is making that. Everybody's calling it the first of 2024. So maybe there's something in the water that we've all been preaching about here in the precious metals world, as far as looking at alternative types of investments that protect you from things like bank failure, seizures, FDIC payout issues on a broad scale, inflation, you know, the list goes on as to the reasons why you look at diversifying into things like precious metals for a portion of your portfolio. Well, maybe the rest of the world is starting to see it that way too, is that this is a chronic illness that we're facing. It's every single week we can talk about a different thing, and they're all major potential crisis issues. China, Taiwan, Ukraine, Russia,
Iran, Israel,
Hamas, Israel, you know, the banking system.
What do you do when your economy is floundering? You go pick a fight with your neighbor.
Yeah.
Yeah, that is the great concern. And it's the major distraction. It's the major economic stimulator. Unfortunately, it comes at the ultimate cost, and it's wrong. Instead of just reining it in, you know, we've become the source for the World Welfare Program and the primary funder of all conflict. And you can't have both of those continue to drain our national treasury. That's assets leaving too. Like, it's not doing anything to better our economy in a sense. It's bettering certain market sectors, and there are some people getting incredibly wealthy off of that redistribution of wealth, you know, in those couple of directions, but it's not good. And unfortunately, the Federal Reserve is so masterful at creating and bursting bubbles. There's a lot of money made on both ends of it. But for the stability, the predictability, it does come down to gold. And more so than ever, to me, it's baked in that we're going to see $3,000 gold in the next 12 months.
Absolutely.
Yep.
Yeah. And there have been people that have been critical of us because they're like, you're not strong enough about what's coming. And I think that's a legitimate criticism, because we are looking at support levels more often than we are looking at upper ranges for the gold price. But I agree, we're going to see $3,000 gold in the next 12 months. We should be at 2,500 to 3,000, possibly that high. We'll be over 2,500 by the end of this year, almost guaranteed.
Totally agree.
Maybe even 3,000, depending upon what ends up happening. But our economy, unfortunately, is shifting from butter to guns. In the whole butter and guns dichotomy of economic theory, the world is moving away from butter and moving towards guns, and this is a scary time.
Well, Miles, you pointed out last week gold was up 50% in 17 months.
Yeah.
For us to go to 3,000 is only another 23% increase from here. So count on that in the next 17 months. There's nothing that's changed that's going to halt this progress.
No.
So
nothing.
when we start to see those things, then we'll be real. And
Well-
we'll say, hey, here's an indication that the gold price may actually come down and stabilize.
Well, let's hope it can.
Yeah.
But go to China right now, like we talked about last week, 20 to 30-year-olds are paying 20 to 30% premiums for physical gold. Right now in China, their demand tripled from the first quarter this year. If that demand continues, and it may, they will absorb all new gold coming out of the ground for this year.
There you go. Supply will be pinched.
Mm-hmm.
Demand stays high. When the West starts becoming buyers, we haven't even, holy smokes indeed, we haven't seen anything yet.
No.
Because when Americans start buying the gold,
Yeah.
now watch out, because you've got a double bonus right now. You've got spot price that you may feel like is overpriced. We talked last week's show. It's not. Go back and listen to last week's program.
It's not
It's
overpriced.
not overpriced. Two, you've got premiums that are lower than at any point in our 52-year history, according to our numismatist. He has not seen premiums this low other than one other time, and this matches that lowest. So same thing with silver American Eagles. People are paying today for a silver American Eagle what they were paying 2 years ago, with silver up about $5 an ounce. You need to be acquiring when premiums are low. So you've got both benefit here, where we haven't seen anything yet spot price wise. They're in absolutely reasonable ranges.
Yeah.
Premiums have completely evaporated.
Just give it time, Tori. You're going to see 20% premiums on Krugerrands just like we did 6-7 years ago.
Yeah.
And lucky to get them.
Yeah. That's the other problem, is what does supply actually look like?
Yeah.
Look, I'm just going to keep talking about things like pullbacks until I'm done buying. That's sort of the way I look at it.
You're jawboning the market down.
Yeah, I'll worry about where gold is going when I've got no more money left to buy anymore. And being in my 40s, I got a ways to go on that.
Yeah. Well, Rob said that 40 years ago, and he's never stopped buying. Have you, Rob?
Yeah, but Rob, what was it again? We talked about this last week. What was that first ounce of gold cost you?
$100.
$100 for a single ounce of gold. You know, you waited a year too long. You probably could have gotten it for 50 or 60 if you'd done it a year earlier.
If I'd have been smart.
That's right.
Yeah.
But did you stop buying, Rob?
No.
All right. That's all we need to know.
Oh, one last thing just for fun. So Republic First Bank bought out by Fulton Financial. Their stock price jumped about 8.5%, so that's kind of nice. I'm only bringing this up. I find it interesting that a major bank goes out of business, so the buyout ends up coming from a company traded on the NASDAQ, not the New York Stock Exchange. So maybe that's just pointing out where the world is going forward. But I don't know. I just found that interesting.
That is interesting, and it brings up one other point. I mean, the merger and acquisition is another way that bank failures are being hidden, right? So we talked about the branches, 220 branches closing in 2024. That's a tightening of the belt by these banks, laying people off, tightening of the belt. So are mergers and acquisitions. Instead of a bank having an outright failure, they'll be absorbed or acquired from another. Well, in the 1980s, there were 14,000 banks in the United States. Come 2008, that shrunk to 7,500. Now, today, 4,025. It was 4,026 last Thursday, but we had the failure. So now you're 4,025. Listen to that number. You've lost 10,000 banks since the 80s. It's an unsustainable ride they're on, and it's mergers, acquisitions. The bigger banks get bigger. A lot of the COVID effect that we saw, and it's continuing here. And you guys, again, we haven't seen anything yet in the banking sector.
No, I think that's still coming. And Miles, finish us out on the parity with platinum and palladium.
Sure. Real quick, as I'm changing charts here. So if it took 20 years to cut banks in half, then it took 10 years to cut them in half again, from 14 to 7, then 7 to 4. So 5 years from now, we'll be down to 2,000 banks. So that's where I'm going with that. Platinum and palladium, it's worth mentioning here to close out the show. It's got to be there, guys. It just has to. I know platinum and palladium, and looking at the ratio, we don't have the same history. We don't have the same repetition as you do with things like gold, silver, or even like gold in the Dow. But it just has to be there when you're looking at the ratio play between the two. And seeing platinum and palladium starting to flirt with parity today, looking at a 1-to-1 ratio today between the two, starts to feel real good. Now, I still don't think we're quite there yet. I'm willing to be convinced otherwise, but I still don't think we're quite there yet.
No, I think you'll see palladium back up to the $600-800 range and platinum stay at around 1,000. And then that's what I'm hoping for. That's my crystal ball.
Right.
I would love to see it. And don't forget, platinum and gold
Yeah.
should also be at parity. So we're going to have to
Been there
weigh the
before.
price action in platinum because it's half the price of gold, less than half the price of gold.
You're right.
We've seen platinum twice the price of gold. So
Yes,
if
we
platinum really gets a run, we may move into palladium, we may move into gold.
There you go.
All roads eventually lead back to gold. It just depends on how
right.
many you want to take. So then I guess that's going to do it this week for Golden Rule Radio. So as always, we appreciate you stopping by. Hit the YouTube buttons for us if you don't mind. It does help us out. Get in front of a couple more people. That would be great. Certainly love to speak with you if you ever get the chance. Give us a call. Happy to talk with you about your personal precious metals portfolio. We can be reached at 800-525-9556. And finally, if you'd like to just see a little bit more info, we are out there at McIlvaney.com. We're on Facebook at McIlvaney Financial.
And we're
Twitter.
on X also, right?
Yeah, we're on Twitter at ACA Gold. So that's going to do it this week, guys. Hope you have a great week, and we'll see you next Thursday.